Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel, please subscribe. In this video, I'm going to talk about how credit scores are calculated, what factors impact credit scores, and how they might impact you. Let's get right into it. As you maintain your finances and manage your expenses, keep an eye on your credit score. Some of the reasons to monitor your credit score are so you can take out a mortgage if you plan on buying a home in the future, or even refinancing if you already purchased a home, rent somewhere to live, take out a car loan, or apply for new credit cards. I think the importance of having a good credit score when you're young to build up a strong credit history early is not emphasized enough. It partially allows you to borrow money at all points during our lifetime, but it's most important when you're young and trying to build wealth or start a family. Generally speaking, when you're younger, that's when you'll have less wealth and are more likely to borrow through different sources like credit cards and personal loans. With that, let's get into what is pulled from your credit report to reflect into a credit score. Your credit score is made up of 35% payment history, 30% amount you owe or utilization ratio, 15% length of credit history, 10% types of credit you have and credit mix, 10% new credit open. Payment history is the biggest portion of what makes up the calculating of your credit score. The reason is because if you're looking to borrow money, there needs to be some proof that you can pay it back. Otherwise, why would they lend it to you? When any lender looks at your credit report, they are trying to figure out, if I extend this person credit, will they pay it back on time or at all? They will look at how you've repaid your credit in the past in addition to looking at if you paid it back. Your payment history includes things like credit cards, department store accounts, personal loans, car loans, student loans, home equity loans, and mortgage loans. Your payment history will also show a lender details on any late or missed payments, bankruptcies, foreclosures, and collection information. Credit scoring will look at how recently and how often you missed a payment, how late your payments were, and how much was owed. If you've had multiple types of credit, your payment history will look at how many times you've been delinquent in relation to your total amount of accounts. So if you have 5 accounts and you've had a late payment on 2 or 3 of those accounts, that will probably impact your credit score. The amount you owe or utilization ratio is the second biggest portion of what makes up your credit score. Think of this as how much of your available credit you use versus don't use. Typically, lenders like to see that you are being responsible with the credit available to you. So for example, if your available credit is $8,000 and you usually use less than $1,500 per month, then you are using a small percentage of what's available for you to use, which would be good for your credit score. Lenders don't like to see someone that has $8,000 of available credit who use well over $5,000 every month, because it shows that person might be overextending themselves to the point where they may not be able to pay it back. And this would negatively impact their credit score. This concept is called credit utilization or utilization ratio. The general rule of thumb with utilization ratio is to stay below 30% of your available credit limit. Anything higher will impact your credit score. This applies to each credit card and your total utilization ratio. The length of your credit history is the third biggest portion of what makes up your credit score. This details how long various different credit accounts have been active. It takes into consideration both how long your oldest and most recent accounts have been open. Even people who haven't been using credit for long may have high credit scores depending on how the other categories of their credit report look. Lenders like to see that you have a history of paying off your credit accounts on time, which will increase your credit score. Types of credit and credit mix is one of the smaller portions of what makes up your credit score. Your credit mix will consist of various credit cards, retail accounts, personal loans, student loans, and mortgage loans. There is no need to have one of each type, but lenders like to see that you can manage accounts of different types and multiple types of credit. New credit opened is one of the smaller portions of what makes up your credit score. If you're opening too many credit accounts in a short amount of time, it is a sign that you could be grasping for credit. From a lender's perspective, that would represent a greater risk, especially for people who don't have much credit history. Try to avoid opening too many accounts too quickly. This causes hard inquiries. Hard inquiries can happen if you apply for credit and the lender checks your credit in response to your application or request for credit. If you have too many hard inquiries within a short period of time, it can make a lender feel like you might be grasping for credit and potentially become a higher risk. The time period varies depending on who is calculating the credit score, but it can range anywhere from a couple weeks to almost 2 months. There are also soft inquiries, like when you check your own credit score or get a pre-approved credit offer from somewhere you already have an existing account. Soft inquiries do not impact your credit score and are not visible to lenders that check your credit report. Some other factors that impact your score outside of these 5 categories are frequency and severity of late payments, number of credit accounts, total outstanding debt, and any filings for bankruptcy are taken into account when calculating credit score. There are 2 primary scoring methods to calculate credit scores, and one of them you may have even heard of as FICO score, the other being Vantage score. Each of them ranks the 5 categories slightly differently in terms of what is more or less influential as part of their scoring system. This is the reason why you can check your credit score, and it can be different depending on which score is being used. I'll put those differences right here, from most to least influential. So both scores look at payment history as the most important factor when determining a credit score, but FICO's score specifically focuses on payment history on loans and credit cards. Vantage score looks at overall payment history. Oddly, the least influential factors are different. For FICO, it is credit mix and new credit, but for Vantage, it is recent inquiries and available credit. Now that you know how they are scored, once you actually have a score, you'll need to know what they mean. I'll show both ranges for FICO and Vantage and how they differ slightly as to when they cut off into the next range or band. They go from exceptional, very good, good, fair, and risky. So scoring within the good range will get you average interest rates when borrowing money, so you want to get at least the very good, if not exceptional ranges to qualify for the best interest rates with either scoring system. That translates to a score of at least 780 or higher, but you can see from both of these ranges that most people fall under either very good or good. So the second or third ranges, depending on which score you are looking at, meaning most people have either an average credit score or just above average. To sum all of this up on credit scores, when you use any credit wisely and pay them off responsibly, like consistently making your mortgage payments and paying off your credit cards each month, actions like these to pay off borrowed money increases your credit score. Know what your credit score is before making big purchases to be able to negotiate for better interest rates. If you're trying to build credit or trying to help someone else build credit, adding an authorized user to a credit card builds credit when the primary account holder is responsible in paying off that credit in a timely manner by making on-time payments and paying off balances in full. It helps increase the credit score of the authorized user. Authorized users get an identical credit card that is linked to the primary cardholder's line of credit, but are not responsible for paying off the charges they make on those cards. The primary cardholder is fully responsible for all charges made on that credit card. Authorized users can also potentially drag down the primary cardholder's credit score if they make irresponsible charges on the card. So as much as it can benefit an authorized user, it can also negatively impact a primary cardholder. Eventually, you should shift towards having credit cards in your own name. This is only meant to start building credit. It's not a permanent solution. If adding or becoming an authorized user isn't an option, getting a secured card is a good alternative. Secured cards are meant to help people that either have low credit or no credit history at all. A small deposit is required in exchange for a small line of credit of around $100 or a couple $100. The deposit is usually equivalent to the line of credit that is offered. Once there is proof that the secured cardholder can handle the credit card responsibly, they'll get their deposit back and probably receive a credit line increase. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.